Okay. Am I live? There we go. Okay. Awesome. I am live. Cool. Hello, everyone. Welcome back to the webinar series about taxes and more. My name is Ziguniso Alimova. I'm a mortgage advisor with Micro Mortgages down here in Wellington, based in Waikanae. And tonight I am joined again by Shane Story from Palmerston North. From Shane, was Story and Associates. For a moment there, I forgot where you are. Story and Associates. Shane, welcome back. How are you tonight?
Hey, Zib, good.
And thank you so much for actually coming back, because we did this together a month ago. We touched on some points. Today, we're just gonna go deeper, I understand, into residential property, residential rental property taxation. So if you don't mind, take it away and teach us something new today. And then at the end, if you guys have any questions, please feel free to put them in the chat box for me or comment if you're watching through YouTube, and we will ask Shane those questions. Now, remember, the main disclosure is this is for information purposes only, so please do not take this as a personalized advice. If you need more information, please go to Shane and he'll sort you out. Thank you. Shane, take it away.
Hi, everyone. Tonight, covering taxation on rental properties. I've got a general philosophy that tax is your number one expense in life. You can't avoid it, but you can manage it. And through managing it, there's several principles to follow. So I'll walk you guys through this based on the 31st of March 23 tax returns, which is the 1st of April last year, 22 to 31st of March 23. Okay, we go. Just again, a general disclaimer. This is a general explanation. Your own personal circumstances to completely change how the following is applied. Tax law is a moving target, and within 6 months, you can actually be out of date. We are constantly having to update and upskill and learn where the tax is heading. So residential tax, income tax. Because again, I said it's from the 1st of April 22 through to the 31st of March 23. All right, so one of the first things to take into account is ring fencing. It applies to residential land. Same as a brightline test rules. Covers property worldwide, not just New Zealand. All right. Rental losses can only be offset against other property in your own name, i.e. LTC, look-through companies, partnerships, personally owned. You can transfer offset between company to company, but only if those companies are 100% owned, but not trusts. Rental losses get captured in trusts and they sit there until such time in the future as you make a profit. All right, losses are carried forward for future rental profits only, and or brightline test taxable income. So if you sell a property, you've got to pay tax on it. You can use your ring fence losses to offset against those. What's interesting is those accounting fees, what we charge you as accountants, you can claim those. They're not caught on the ring fencing. If property was purchased with the intention to on-sell, there is no ring fencing in the intervening years, which is basically the holding costs, the interest, the rates, the insurance. Those losses can actually be claimed on a year-to-year basis. But IRD will need to be notified that this is your intention. And of course, your intention is to make a profit. Therefore, it will be taxable.
Shane, just a second. How do you notify IRD of your intention?
By lodging the return and claiming the loss.
Uh-huh.
I've just had a couple of things go through my desk today. And two things with trading property. if you're trading and your turnover is going to be more than $60,000, you'll need to be seriously looking at becoming GST registered. And you end up paying GST on your profits. But that's a whole can of worms that you'll need to be aware of. And if you're actually going to have a rental portfolio for investment purposes and a trading portfolio of property, you're better to have it in two entities. And you have your GST entity in a company, for instance, so that the two don't get mixed together and don't get tainted. But again, there's a whole can of worms in there that you need to have a talk to someone as to where you are at with that.
So ideally, before people really go down the avenue of purchasing properties or looking to make a quick buck and flip a property, they should really speak to accountants about the structure of
very
the
much so.
entity that can do that. Perfect.
Yes, very much so. All right. What's next thing? If a property by area is at least 50% the main home, then the rental losses are not ring fenced. So if you've got your home and you put a granny flat on and you rent the granny flat out, as long as the granny flat is less than 50% of the main home, then the losses are not ring fenced. Who does it affect? Okay. We've noticed 1/3 of clients are making rental profits. We have quite a large portfolio of clients with property. About 1/3 break even, and about 1/3 are making a loss. Of the third that are making a loss, they have potential depreciation clawback because they've been in the property market for quite a few years, and they've got this the building depreciation clawback that goes back to about 2010 is sitting there. When they sell, if and when they eventually sell the property, the depreciation clawback can be offset against the rental losses and the accumulated losses. The other half of making losses, of the 1/3 that are making losses, are negative cash flow. And that's actually starting to become quite a serious problem, the negative cash flow, because from the 1st of April of this year, we're only able to claim half of the interest on the mortgages. Next year it gets even worse. It drops down to 25% we can claim, is all that we can claim. So you may actually be breaking even, but once you add in this extra tax, the surcharge that they're charging on interest, you may be in a negative cash flow position. You need to be fairly confident that your capital gains are making it worthwhile. So we've one of the things to watch if you've got negative cash flows, look at the rents. Now, I had a client recently, they were getting $320 for their property. We checked up on homes.co just for a general idea. They should have been getting $420 to $450. We told them to go and talk to the property manager and look, seriously get that rent up to market level. Property manager said, as it was an existing tenant, it wouldn't be fair to rise the rent more than $20 a week. Because they don't want to take the abuse from the tenants that rents are going up. I asked if they put a new tenant in, what would they be getting? Oh, would be doing it for $420. I got quite vocal with the manager on that one. And I advised the client to fire the property manager. Because as I said to the property manager, if you're not going to put the rent up, then you shouldn't be charging property management fees. That's only fair on the landlord, isn't it?
Yeah.
If they had lifted the rent to $420, the property would break even. And the landlord wouldn't have to be subsidising the tenant. All right, GST issues. If you are looking at subdividing a section up to 4 sections or building 3 houses, up to 3 houses, you don't have to be registered for GST because it's considered that it's not an ongoing basis. But you do need a gap between each of these developments. But if you're doing 5 or more sections or 4 or more houses, the courts have said it is an ongoing basis. Therefore, you will need to be registered for GST for the subdivision. Zero-rated land sales. A lot of developers are trying to sell property based on that it's zero-rated, and they want you to become registered for GST. Be very careful with these, because what the developers are doing is passing the buck onto you for the GST. If purchasing, make sure the contract, if you're the purchaser, make sure the contract says including GST, if any. Be very careful when the vendor asks for your IRD number. Talk to your lawyer about it, talk to your accountant about it, because we have seen some clients getting confused, given the IRD number across, and then suddenly find out that there's been no GST in the transaction. And if they go to sell the section, they will have to pay the GST on it, even though they haven't been able to claim it. Purchaser says they are not registered for GST, then find out they don't register, they have to. If you have a contract that says plus GST, if any, and the vendor finds out that you're not registered for GST, they will lump you with the plus GST. Because you're not registered for GST, you can't zero rate the transaction.
And this can cause, just a second there,
Yep.
From the lending point of view, I've seen few go south when suddenly we discover on the settlement day, for instance, that we are short of funds because the
There's no
GST. Yeah.
You can't claim the GST on it, or it's been zero rated.
Yeah,
which
exactly.
So,
which means no settlement.
yeah, and be careful with that. Sometimes you have to settle, because if you've got a contract that says plus GST, if any, you're not registered for GST on an $80,000 purchase price. Suddenly you've got another $12,000 to pay, or on an $800,000 purchase, suddenly you've got $120,000. You have to pay,
Exactly.
and the vendor can sue you for it. So this is what I'm saying. If you're a purchaser, make sure that contract says including GST, if any. And that way it's 800,000 and they can't lump any more onto it. We've seen this. The purchaser rushes through a GST registration thinking that they're going to save on the GST. They pay the $800,000. But from IRD's point of view, why did you register for GST? Because you can only register for GST if you've got a GST activity. And residential rental is GST exempt. It is not a GST activity. So what GST activity are you planning to do? Develop and on-sell the section? Now, you might buy a piece of land and not develop it for 15 years and then flick it on. But if your intention at the beginning is to develop it, even after 15 years, because your intention at the moment you bought it was to sell it, you've got an activity. And you register for GST, then IRD will take the view that you bought that property with the intention to on-sell it, the GST activity, therefore you've got to pay capital gains tax on it 15, 20 years' time, even outside the brightline test period. Now, even if 3 or 4 years later you deregister for GST and you pay the GST back, IRD will still say, why did you register for GST? You must have registered for GST for an activity, GST activity, development, therefore you're paying capital gains tax. All right, income tax, depreciation clawback. Even though you can't claim depreciation on residential buildings today, prior to the 1st of April 2011, and yes, that is 12, 13 years ago, you are still liable, if you've claimed it, to do the calculation. Now, not all depreciation has to be clawed back. there's actually a very complex formula involved, and it takes into account changes in the value of land. And sometimes the land can be the piece of the equation that has exploded in price, but the building itself has fallen. And chattels come into the equation, plus selling costs, improvements, if you've done any insulation upgrades, all these come into the equation. And if the building itself has not lifted in value, there's no depreciation clawback. Now, if your books say there's $50,000 worth of depreciation on the books, that does not mean you pay tax, $50,000 tax. What it means is that the $50,000 is taxable. You pay tax on the $50,000, not the $50,000 itself. And as I said before, that depreciation clawback can be offset against any ring fence losses.
And Shane, sorry, just a question
Right,
here.
brightline test. 2 years no longer applies. The 5 years is coming up. We're still in, some property is still in the 5-year period, and the 10-year rule kicked in from the 27th of the 3rd, 21. Those are quite important dates to remember. Be careful of the effective purchase date and sales dates, especially between associated entities, trusts, companies, LTCs, individuals. But what's the effective purchase date and the sales date? Brightline starts on settlement. It finishes on when the contract is signed. Not when it goes unconditional, not when it's settled, but when it's signed. And IRD are actually monitoring this. We had one inspector chasing us, trying to tell us the property was sold in October, when we had all the paperwork that was actually in February. And he tried to tell us that the contract was signed in October. So we had to send them all the paperwork to show when it was actually signed. So watch those dates, it can catch you out.
So it goes by, sorry, Shane, it goes by when people signed versus actual unconditional and settlement.
Yeah. So the normal process is you sign today, which is the 17th of July. You've got 2 weeks to go unconditional, which is sometime at the end of July, and you have the settlement in mid-August. Now, the settlement in mid-August is the starting point of the bright line, but the finish of the bright line for the vendor is when the contract was signed.
Oh, so as a vendor, it's super important.
Yeah.
Not to sign before your time's up.
Yeah, watch that date, because most people will think, oh no, that's within
When it settles.
August. Yeah, I bought it 5 years ago, and at the end of July, so I'm settlement. It's mid-August. I'm fine. No. It's today.
Wow. Again, it goes back to the intention, isn't it? When was
It's not even the intention. It is when was it signed? Not even when it went unconditional.
Wow.
When did you put pen to paper? And they're looking for that sort of thing.
That's amazing. I didn't know that. That's amazing.
Now, associated entities, trust companies, look-through companies, individuals. Depending on the dates, now the 10-year rule came in on the 27th of March 21. IRD mucked around for about a year and then said, oh, we will give rollover relief if you sell it from yourself to a trust, as long as the trust, your trustee, beneficiary, settler, the trust can have rollover relief as if it had purchased it originally. But that's for sales after the 27th of March 22. If you sold it to your trust sometime in August last year, in August 21, you don't get rollover relief and the clock gets reset, and even though you're selling it to yourself essentially, you don't get rollover relief and you're up for brightline test taxes. So there's some pretty important dates in these. The other important date is code of compliance when you build a new property. That's from the 1st, so the 27th of March 2020. So we've got all these different dates. We have to be very, very careful. And as we go through doing the returns, we're actually noting these dates as they change on the work papers, because there's some pretty big taxes involved.
And Shane, I'm sorry, but it just made me think. For instance, if someone signed away, thinking the 5 years is up for them on the sales and purchase agreement, but how would IRD know? Like, if the people didn't keep a copy and the real estate agency closed down and the lawyer's no longer around, like, how do they take it down?
Land transfer office. And a lot of that is electronic.
So it will have some dates, right? It will.
Yeah. And sometimes I'm not absolutely au fait with it, but there's a pretty good chance they'll have a electronic copy of the paper signed. Now, real estate agents shut down, the lawyers shut down. That will be very unusual.
Yes.
But they will go back, to the lawyers and ask for it.
And your role as an accountant would be getting heavily involved, actually, noting down those dates as well. If it came down to, do you pay the tax or not pay the tax, you need to get that paperwork to determine.
Yeah, very much so.
Yeah.
And if you get those dates wrong, there's several clients we have said to them, your dates are not matching up. You're going to be up, if you sell that property today, you're going to have a $30,000 tax bill when we do the returns at the end of the year. Or even one case, it was $100,000. Oh, no, the lawyer said we're fine. I'm glad that we had the emails in capital letters, you will be taxed on this. And the client's gone back and argued it out with the lawyers on it. But $100,000 is a hell of a lot of tax to pay, especially if it's like a $300,000 profit. Now, in that instance, the client was earning $120,000 a year. They went from, but their tax returns was 120 plus 300. So they breached the 180,000, and more than half of the tax of the 300,000 was taxed at 39 cents in the dollar.
Wow, at the highest bracket.
Yeah, it was quite brutal. So check the dates and get it in writing from the accountant, from the lawyer, that these are the dates that you can sell or you can't sell.
Thank you.
Cool. Right, what else? Yeah, again, when the contract is signed, that is the sale date for the vendor. So purchaser settlement date, sale is signing of the contract. Now, this is some of the interesting ones we've had. We had purchased to live in, but never actually moved in and sold 6 months later. Because they hadn't actually moved in, it wasn't classified as their home. Therefore, it was sold 6 months later. I think in this instance, the woman bought the property thinking she was going to move into it. Boyfriend proposed. She moved in with the boyfriend, did the house up, sold it after 6 months. She got pinged because she didn't actually live in it.
How would they know if that's the main question I often get asked. If I buy as a property to live in, and if I don't live in it, how would they know?
Well, first of all, we're dealing with cynical, skeptical IRD inspectors. They've heard all the bullshit before. Secondly, you are guilty until you can prove your innocence with IRD. So if you sell a property within 6 months, they'll come and ask you, all right, what are you doing about the taxes? You say, oh, I've been living in it, so I'm exempt. well, can you show us when you moved into the property? And in this instance, the client said, the IAD said, when did you actually move in it? Oh, I moved into it. She had moved her furniture into it, but she hadn't got the power bill connected. So the power and the utilities did not show she was living there.
Yeah, gotcha.
So IAD, if they've got the scent of blood, they'll hunt it down. And by not declaring it, it is actually not avoidance, it's evasion. And if you try and be silly with IAD, you can be for penalties up to 3 times as much as the original tax.
Yeah, absolutely.
We had one where the section purchased, but 4 years later, nothing was done to the site. But there was a 2-year rule. They were fine. Oh no, sorry, which one? Purchase for home. Oh, that's right. They bought the section for their home, hadn't done anything after 4 years. It was taxable because they hadn't actually moved into it.
But what if, sorry, I'll just stop you back on the second case. For instance, I have clients at the moment, they've bought a piece of section and unfortunately, they can't secure funding to build and they may end up selling. Does IRD even look at cases like this? Like, do they even listen to reason? If
the legislation, so it's not IRD, the politicians have written this legislation, and the legislation says actually moved in.
So they can
did
get
they
a
actually move
tiny
in?
home. So they can get a tiny home and live on a section for 6 months, and then that will be considered they've lived in.
And if they've sold it and they made a profit, they've got to pay tax.
I see. Great to know.
Now, this one, we had a case where they purchased the property and moved in as a home. Then they decided to subdivide the back section off. Then they divorced, and there was a transfer of ownership to him. The section, they sold the section, then sold the home, all within 20 months. None of it was taxable. Pretty extreme, but it wasn't taxable. So it is quite a minefield, and if you work your way through it systematically, we can work out where you're at. All right, intention. Now, intention is over and above brightline. So if we come back here, in this case, had they purchased the property with the intention to subdivide it, even though they were exempt from brightline, they could well have been up for capital gains anyhow. What was the intention at the moment the property went unconditional? Investment versus a trade, a development, subdivide, construct, rezone. A few years back in Palmy, we had a section where there was 21 1 and 2 bedroom flats down the back, and there was an empty section out the front. 2 Dutchmen were arguing over it over 2 years, and finally the first Dutchman had a guts full, put it up for auction. At the auction, the second Dutchman bought it. Half an hour after he purchased it, a guy came up to him and said, we were going to pay $300,000 more for that section than what you did. What do you want to do? And he said that was the easiest $300,000 he'd made in his life. Now, this is before Brightline came into existence, but ID went to him and said, right, we want income tax on that. And he was able to argue his intention at the moment the hammer came down, and that's the deposit hadn't been banked. He was able to argue at the moment the hammer came down, he bought it with the intention to develop it to rent. Now, what happened is that the guy had been caught on a flight from Auckland to Palmerston, And in Palmerston, sometimes the airport gets fogged over, and a plane can circle around for half an hour until they can find a hole in the cloud and land. IRD interviewed the pilot and the control tower to confirm that that plane was delayed. They will go that far to see whether or not you're telling the truth.
Wow.
So there's quite a zone in between. So you can buy a property and not sell it for 20 years. But if it can be proven that your intention was to trade, 20 years' time, it's still taxable. So just reiterate, that's outside brightline. And that legislation has been there for 50, 60 years. And brightline did not override it. It's still in the background. All right, this is what IRD are looking for on the tax returns. You need to be able to justify the full 52 weeks. If you have gaps in it, you need to explain why. Could have been renovated, could have been in between tenants, there could be rent arrears, but you still need to explain it. Now, if there's $2,000 worth of rent arrears, and you collect that in 4 years' time, in 4 years' time, that $2,000, when you collect it, is still taxable. So remember to keep that in your tax returns. So missing rent, downtime for repairs and maintenance, change of tenants. And be careful with that too. If you have a tenant leave and then decide to sell it, and you have not actively looked for replacement tenants, the moment you don't actively look for tenants, you can't claim any expenses on the property. So even though you're trying to sell it, you need to still be actively looking for tenants so that you can claim all the expenses up to the point when you sell it.
And by, sorry, Shane, and by actively, people need to have either ads on TradeMe,
Yes.
or Facebook, or sort of property managers, etc.
So somewhere where an IRD inspector can independently verify you have done that.
Mm-hmm.
Just the fact that you've mentioned it to friends is not good enough.
Yeah.
Bond refunds for rents and for damages. Those are actually taxable. Keep that in mind. Expenses. Now there's a term, the Nexus. And the term of the Nexus means that there must be a direct link between the expenses to the taxable income. So any expenses incurred in generating rental income can be claimed. First of all, with expenses, the purest form of a receipt is a GST receipt. Even though rental income is not GST activity, a GST receipt has all the correct details on it. I sometimes see FPOS chits. All an FPOS chit sees is that something's been paid, but it doesn't give an explanation, where a GST receipt will give that. So it's just good housekeeping for that, so you don't get invoices turned over by IRD. Insurance. House insurance, contents insurance, mortgage protection insurance, rental income insurance. The excess on an insurance claim. So if you've got an insurance claim for $3,500 to repair a bathroom from flood, the insurance company will give you the $3,000. You've got to pay the $500. You can claim the $500. Also, remember income protection insurance. I had a client 2 months ago. We got $7,000 in refunds for them over a 4-year period that they didn't even realize that they were entitled to claim, and they've been paying it for the last 10 years. It's something people miss quite a bit. Right, insurances. Contract is usually for 12 months. When the property is sold, ask for a refund of the unexpired portion. So if the You've only used 2 months of the insurance. There's still another 10 months there that's not being used. If you notify the insurance company the property's been sold, you might need to send them a copy of the contract or whatever, get the refund. Now, if we're paying $2,000 insurance premiums, that's anything from $1,500 you could be getting a refund for. Ex-Gratia Payments. Another client got a meth contamination. His insurance company tried to play on that it was an illegal activity, so we're not going to pay it. He hammered the hell out of them and kicked them a real stink. So they agreed to make a $50,000 ex-gratia payment, which is a real bonus, as I said to him. It's non-taxable if it's ex-gratia. So he was a happy boy. Rates, district rates, regional rates, penalties, water. But if the tenant has contributed to the water, that needs to be offset against it. Payments to friends, family, mates. If you claim, they will have to declare. But a few years back, we had a house burned down. The kids put a big effort in and helped me over the summer. I paid them $7,000 between the four of them. Now, paying them, one, it keeps them happy and not having to fork out money to them all the time. But they've got a 10% tax rate for anything under $14,000 compared to my 33. So it pays for me to pay them, but it's got to be genuine. And I was actually waiting for ID to come and tap me on the shoulder and say, how do you justify that one, Shane? And I was going to put them in the conference room with the 4 kids. And I was going to say to the kids, you tell the ID inspector what you've been bitching, moaning, and whinging to me, BMW, about how unfair it is you have to work on the houses. And I figured I'd give the ID inspector half an hour and he'd come out and he'd tell me, he'd give it to me because it was genuine. Now, cash discounts, no invoice, no claim. Unless they're giving you a discount of more than 33%, you're shortchanging yourself. And what I mean by this is if you've got a job that costs $1,000, you can claim it costs you $670 after tax because you can claim $330 on it. So if someone says, I'll give you a 10% discount for cash, you've paid $900 and you can't claim any tax on it because there's no receipt. So that cheap $900 job has actually cost you something like $230 because you can't claim the tax on it. All right, repairs and maintenance. This can be a right minefield, the difference between repairs and maintenance and improvements. Insulation. If you have a property that had, say, 50 mil of insulation, and that has shrunk since you've owned it to, say, 30 mil, and you top it up back to 50 mil, that's maintenance. You're maintaining it back to its original condition. But if you put another 50 mil on top of it, all of that is now capital. And you can't claim it because it's an improvement. Yes, you can use that in brightline calculations and depreciation clawback calculations, but on a day-to-day basis, you can't claim it. Now, if an improvement, if you've owned a property for 20 years and gradually it's deteriorated, and today you renovate the house, that renovation is definitely an improvement on where the property was yesterday. But are you lifting it back to its original condition when you first purchased it? If you are, it's repairs and maintenance. If it's better than what it was, it's an improvement. So if you've got a bathroom and you move walls around, or you've got a shower bath and you replace the bath with a shower, that's an improvement.
So
but if the shower has deteriorated and you replace it with its modern day equivalent, that's repairs and maintenance.
So Shane, I'm sorry, it sort of has to be like for like
Yes,
in a way.
but in a way, yes. Now, there was a case in England that went to the Privy Council, and it was castles. And 200-300 years ago, they would use cast iron reinforcing rods. And the problem with castles is in England, they're up high and they get hit with salt air. Salt air and cast iron don't mix well, and the cast iron expands and it breaks some water and breaks the castle. So you don't use that anymore. The modern day equivalent is brass. Although they had brass in those days, they didn't use it. Nowadays they use brass, and the Privy Council said that is a repair, it's not an improvement. So there was another case in Auckland where Auckland Gas used cast iron pipes, and they used what was called coal gas. And coal gas is actually quite wet. And they used hemp to seal the pipes. And as long as hemp is wet, it forms a good seal. In the early 70s, they changed over to natural gas, which is methane from Kapuni and from Maui. Those are very dry gases. And by running the dry gases through the pipes, the hemp dried out and the gas leaked. And they were losing something like 10 to 15% of the gas through leaks. So they came through with a concept where they used a balloon, and the balloon went through the pipes and sealed the pipes. That went through the Court of Appeal, and Court of Appeal said that was an improvement. It gave a better quality product. It is a real fine line between the two. And I've done a couple of seminars where they're actually 2 hours long, going through all the different court cases. It would pay to get some help on it. So as I'm saying here, keep the invoices. Even if you can't claim it as repairs and maintenance, the improvement may have an effect on brightline. Now, between 17th of March 2020, or before 17th of March 2020, we could only claim $500. Improvements could be claimed as repairs and maintenance. But between the 17th of March 2020 and 16th of March 21, with COVID, any asset that is depreciable, so buildings no, but stoves yes, driveways yes, up to $5,000 we could write off. But from the 17th of March 21, it dropped back to $1,000, but it's only on depreciable property. So if you get a range hood or a shower fan put in and it costs you $900, we can claim that repairs and maintenance. But if you put $1,000 worth of insulation in the roof that had none before, you can't claim it because we can't claim it as depreciation. We had one client who spent $46,000 on 21 air conditioning units for 21 flats. He had 21 invoices, so we could claim each one as repairs and maintenance rather than depreciating it. Dilapidated repairs. If you buy a property that is deteriorated and hasn't been fixed for quite some time, and its market value is $800,000, you buy it, and then you spend $100,000 doing a whole lot of essential repairs and maintenance. If you do that in the first year, IRD will classify it as dilapidated repairs and maintenance. And it's part of the purchase price. You can't claim it as repairs and maintenance. Now, there have been a couple of cases where taxpayers have won. But the problem is IRD know that the legal fees to fight IRD make it uneconomic. So if you do any improvements in the first year, they're going to be sunk costs. No claim, black hole. You will eventually be able to claim it on brightline. Hold off those repairs if you can until the next financial year. Again, it's the court costs that make it not worthwhile fighting. Again, keep the records. All right, car mileage. The kind of expenses you can claim. One which we regularly see with new clients coming on, they're not claiming the car mileage. Clock up 1,000 Ks and I can get you about $300 in tax savings. Now this is a trip to the tip, trips to the hardware store, trips to the council, to the bank, come and see the accountant, see the lawyer, see the real estate agent. Put down the date, principal reason for the trip, which of course is going to be for the rental property, and the number of Ks. Drive-by inspections you can't claim, but if you get out of the car and cut one blade of grass on the property, you can claim the mileage. That's the fine line.
And Shane?
Through all of these sort of things.
Shane, so for instance, if you use it, if you've got the property and you're doing it around the property and stuff, oh yeah, I see you've got conferences there as well. The key is really to have the logbook, write down the start of the mileage, the finish of the mileage for those
No.
No?
Now, yes and no. Yeah, that's a great accountant's answer, isn't it? Yes, if you have multiple properties and you are intending to claim 20, 30, 40, 50, 60, 80% of the car's cost, you need to keep a logbook for 3 months. And if you're doing more than 100K business-wise, it's worthwhile doing it. And then you can claim a percentage of registration warrant of fitness, depreciation, interest on HPs, repairs and maintenance, fuel. So you have to record every single trip for 3 months. But most people, mum and dad with one rental property, might clock up 2,000 Ks in a year. So in that instance, the second option is you keep the logbook, you put down the date, the principal reason for the trip, to go and see the accountant, for instance, and the number of Ks on that particular trip. And at the moment, it's jumped from 83 cents to 95 cents a K we can claim. That make sense?
Yep. Will IRD ever ask to see that logbook?
Yep, logbook. And new clients coming on board, we send them a logbook.
Oh, wonderful. I own a stationery shop and we sell logbooks a lot.
Okay, travel expenses. If you go, and this year Property Investors Association has a conference in Queenstown. The airfare is down. The hotel, the meals at the hotel, Cook Strait Ferry if you drive down, conference fees. All of these can be claimed because the conference is to do with rental properties. The Nexus is there. You're learning more about how to invest in property and run your property investments more efficiently. All these expenses can be claimed. And it can be things like subscriptions and books, subscriptions to Property Investors Magazine, belonging to a Property Investors Association, and there's a dozen around the country. All of these things are related and can be claimed.
So I'm looking forward to going to that Queenstown conference, hopefully later this year. I believe it's around October.
Yes, it is.
Can I claim bungee jumping in Queenstown or jet boating while I'm there?
There's going to be a difficulty in associating that with investing in property.
Hey, some important conversations sometimes happen around fun activities, extreme sports.
Yes, but again, I've got to deal with a cynical, skeptical ID inspector. And I have literally had them sit there on the other side of my desk and say, Shane, that's a good bullshit yarn, but you'll have to come up with a better one.
Gotcha.
All right, depreciation. We cannot claim depreciation. We cannot claim depreciation on residential buildings. But if a chattel is not attached to the building, we can. So decks can be claimed, but not verandas, because they're attached to the building. This is the logic. Hot water cylinders can be claimed, even though they're an integral part of the building, even though they're buried deep inside it, we can claim. So there's some bizarre rules in it. But we can on chattels. And for about 350, we've got a team valuer in Palmy who will do a quick and dirty valuation for chattels and for ID purposes only. And he will go to the property, have a quick look at it and go, a property of this age, of this style, from this era, here's a list, and we've got a list that he ticks off on, and he will give a value. Now, one, we can claim the $350 valuation as an expense, and we've seen that clients save about $5,000 in taxes over about 5 years. And we don't have to do a chattel valuation on the sale. IRD accepts the closing book values because the chattel do depreciate. All right. Loans. So things like bank fees, loan fees, break fees, early repayment penalties. However, these can be affected by the non-deductibility interest rules. So we may be able to claim 100%. It may be 75, 50, 25. We may not be able to claim it. But still, get this information through to the accountant, because if you don't, I can guarantee you won't be able to claim it. But if you do bring it through, there's a good chance we will be. If a bank makes contributions to legal fees, if you've got $3,000 legal fees and the bank gives you $5,000, then 3,000 of that is neutral because it neutralizes the legal fees, and the other 2,000 is non-taxable. Now, with loans, the golden rule is it's not what it's secured against, but what it is used for. If you have used your grandmother's Visa card to buy properties, I don't recommend it. I tried it, get into trouble with it when I was younger. If you use your grandmother's Visa card to purchase a property, even though the Visa card is in her name and the interest is charged to her, you can claim it as long as you can show that that money was used to purchase the property. However, since the 27th of March 21, we cannot claim the interest on any property that you purchase that's already a second-hand property. If you buy a property brand new with a new code of compliance, then we can claim 100% on it. But any other property, we can't. Any property purchased before the 27th of March, we've got this 27th of March 21, we've got the non-deductibility rules. And this year, we can only claim half the interest on loans. Next year, we can only claim 25%. And if Labor get back in again, there's going to be a lot of people are going to have to get out because they won't be able to afford the losses. Now, National and ACT have both said that they will remove ring fencing, and they will, well, hang on. National has said that they will look into removing ring fencing. ACT has said they will get rid of it full stop. They've both said that brightline will come back to 2 years, and they have both said that we will be able to claim full interest deductibility again. Now, National hasn't given an exact date. They've been a bit vague on that. If they get back into power, I'm picking that you will only be able to claim 50% in this year, but the next financial year, from the 1st of April 24, it goes back to 100%.
You reckon? You reckon, Shane? Because I've got a feeling, and I'm not an accountant, I'm not that great with numbers. I think the National might come into power, or whoever else will, look at the books and go, oh, we actually made quite a lot of profit doing it this way. Especially since COVID, they went just cash everywhere and made a massive dent in the books. I feel almost that they will look in the books, think it's looking great. How about we just keep it that way and not fiddle with it?
Well, yeah. How do you know if a politician's lying?
I've heard this one before.
Their lips are moving. My gut feeling is they will put it through. They've made the promises, and landlords are the natural supporters of National. They will be burning a whole lot of bridges by doing it. Now, the ring fencing, they may actually keep that in for a while with the excuse, oh, we need the money. That one could take a while to reverse. But if Labor gets in, it's guaranteed it won't be reversed. So you run with one who says they will, or you run with one who says, no, we won't bring it back. And there's going to be some pretty big money involved in that. So if you've got interest bills, especially with the rates being so high, of $40,000, that's $17,000 worth of taxes you can't claim, or you will have to pay even though you're paying the interest. So it's going to be quite brutal if they keep it in.
It will be. It definitely will be. I'm not looking forward to it.
Yeah. All right. Right. Administration. So stationery, bank fees. And stationery is pen, paper, books, all that sort of thing. Postage, couriers, computers. So the printer cartridge on your computer. Now, probably we can only claim a percentage because there's private use and business use, but you can still claim it. Internet costs, the subscription, we can claim on that. Gifts to tenants. Personally, I don't approve, but if you give a gift to a tenant, then you can claim that as an expense. Subscriptions. Now, in the old days, we had the Evening Standard and the Manawatu, the Dominion in Wellington. Because in those newspapers, they have articles on interest rates, on property for let, on property for sale, government policies in the news. You can claim those costs. If you belong to a property investors association, you can claim their cost. Valuation fees, accounting fees, property management fees, advertising, cell phone. Can't claim 100% unless you can justify it, but you can claim a percentage. Car mileage, as I've already said. Home office, we can claim a percentage of. Home phone, internet computer. If you buy a computer and you use it for managing your properties, we can claim a percentage of it. A percentage on the depreciation. Insurance on your house and contents, rates. Interest on the mortgage, but that's, again, sometimes it can be subjected to the non-deductibility of interest rules. Power, gas, the lawns, repairs and maintenance on your home. Again, we can claim a percentage of these. On their own, they're not worth it. But when you get them all together, car mileage, home office, chattels depreciation, suddenly we can turn the tax situation around. Now, legal title. There was a while back where we could claim the first $2,340 tax-free for kids, but they shut that one down. But if you've got a trust, you can distribute gross rent and not net rent and claim, especially for kids over 16, we can get $14,000 to them and you only pay 10% tax or 10.5% rather than your 33%. So there are some opportunities that we can work with in there. So sometimes it pays to pay tax. So even if you create a loss by distributing gross income, but the losses accumulate, you are still buying these tax losses at 10% to save you having to pay it at 33% sometime in the future, or 39%. And I like trust in the sense that if you have a property with both your names on it, and you've got one partner who stays at home to raise the kid and the other one working, you have to split the income 50-50. And I've seen people split the income 100% to the spouse because they're not working and they've got a low tax rate. You can't do that. If the title says 50-50, the loss or the profit has to be split 50-50. But if you put it into a trust, the losses accumulate in the trust, but we've got that with ring fencing anyhow. But the profits can be distributed whatever way you like. And they can go to the spouse that's got the low income, and or they can go to the kids who've got the low tax rates. So legal title. Whoever is on the land title is required to lodge the return. If in joint names, you've got a virtual partnership. There's a 50-50 split. Not whoever has the best tax position. IAD look for this sort of thing. You can actually have it 99-1 on the title. So it could be 99 to mum and 1% to dad, but that has to be on the title. And you can't do it retrospectively because the only motivation for it is avoiding tax, and they will override that straight away. But if you do that on the purchase, then you can.
From the mortgage point of view, usually we get asked by the bank as well. Not often, but every now and then the bank, if we know, especially, the bank wants to know how the ownership is made up. So for instance, if it is 99-1, then there might be a situation where, as you say, mum doesn't work, dad does, but then we can only account for 10% of dad's income, 1% of dad's income, and we have to rely on 99% of the mums. For instance, if it's just
what I've seen in that situation is the bank will say that they are jointly and severably liable for the mortgage, and they cross guarantee, but the title still says 99-1.
Yeah. So they're just something people need to be also aware. And obviously, different banks treat clients differently. So one bank might do it this way, the other bank might turn around and decline it based on that. So again, the structure really matters.
And it comes down to the title for IAD purposes. All right. Tenants, boarders, flatmates. A tenant rents a property. A flatmate rents a room but shares in living and domestic costs. A boarder pays for a room, living and domestic costs. If you have 4 or less boarders, you can use the income, it's the rental income less the prescribed IRD rates. And IRD have standard model costs per flatmate, per boarder. It can be done. We've got the numbers for that, etc. And that actually can make it easier than having to do all the paperwork, collecting receipts and so on.
And I believe if
HMO.
Shane, I believe if you've got an international student, you don't have to pay tax on an international student, right?
Yes, you do. But you take away the prescribed IRD cost rates. So IRD may say it's $150 a week is the prescribed rate. And if you're being paid $200 minus the $150, you pay tax on the $50.
Okay.
So it's not a get out of jail card. Now, if you're being paid $140 and the prescribed rate is $150, then there's no tax in that situation. All right. HMOs, house of multiple occupancy. This was getting some traction about 3 years ago, and it really set off the alarm bells for me when I went to the presentation. It's one house, but it has 2 to 6 different tenants in the same house. In the UK, they've got legislation for this, and in that legislation it says if you've got 6 different tenancies in the same house, your fridge has to have 6 different compartments. It's been heavily promoted. It was being heavily promoted in New Zealand to go invest in the UK, and there was some of it going on in Auckland. This is, again, you have to be licensed if you've got more than 2 to 6 tenants. Again, you have the separate compartments in the house. The mentorship programs were going for $40,000 to $80,000, and the particular firm that was pushing it quite hard, that came to New Zealand, I've heard that they've actually gone into liquidation. Yes, it's floating around. Personally, I've got 6, 7-bedroom student flats. I rent the whole house out, and they can sort it out amongst themselves as to how they pay it. I don't want the drama of trying to find tenants to move into empty rooms. Some people specialize in it, and we do the books for them and so on, and sometimes they do well, sometimes they don't. Me personally, I don't like them, but if they work for you, go for it. Okay, general rules with dealing with IRD. Today, that should be March 23. We're working in the financial year to year ending 31st of March 2023. If you're filing it yourself, you should have had that lodged by the 7th of July, 10 days ago. But if you've got an agent, you have until the 31st of March next year to get last year's return lodged. So an agent like myself or accounting firm, it gives you that extension of time. All right, general housekeeping. With IRD, follow the law. Don't try to be too clever. Certainly follow the law. If you can claim it, grab it. But being too imaginative, you only antagonize the inspectors and they will start digging deeper. It's called the Nexus. Make sure there is a direct link of the expense with the taxable income. Okay, expenses. Burden of proof. In New Zealand, we have what's called a compulsory voluntary compliance regime. It means it's compulsory to voluntarily comply. Bit of a contradiction, but that's how they work.
It doesn't make sense to my English as a third language, where it's compulsory, but it's voluntary.
Yeah, you volunteer the information, but it's compulsory to volunteer it.
Nice.
With the IRD, you are guilty until proven innocent. So you need to have your documentation lined up to say, here's my income, and I can explain the whole 52 weeks why there's holes in it. Here's my expenses, and here's the receipts to prove it. All right. It may be tempting to try and slip something in that you shouldn't claim. However, and the chances of being caught are slim, but if you are caught, you will wish you had not. The drama and the stress involved in IRD audits is quite soul destroying, especially if you've got it wrong. If IRD don't like it, the legal costs, you might think, oh no, I'm going to fight IRD. Keep in mind, do you want to be rich or do you want to be right? Being right costs a lot in legal fees, and it's probably uneconomic to challenge it, and they know that, and they will play to it. So 8 rules as to how to avoid an IRD audit. 1, file the returns on time. If you don't have an accountant, get your returns in by the 7th of July. If you do have an accountant, get it in before the 31st of March. And by the way, if you bring your returns into the accountant on the 20th of March next year, don't expect them to file it on time. Pay your taxes on time. If you can't pay on time, you can go to IRD and say, I can't do it. And it's what we call the Bank of IRD. And IRD will put it on tick for you. Now, I think the interest rate's about 9% at the moment. And you can pay it off at any time. There's no penalties for paying it sooner. They charge a 1% penalty fee. So if you've got a $10,000 bill, you have a $100 setup fee and then they can spread it over 3 years if you want. And tick, 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 and pay it off. Declare all the income. Tempting as it may be, still declare it. If you get a reputation with IRD, they treat you as fraud. Don't try to be too clever with the expenses. Be polite. Be cooperative. Don't be abusive. Even that tax agent. When IRD draw up a list, and they did this a while back with real estate agents in Palmerston North, and they said, right, how many people are fours? They don't pay on time, they're abusive, they don't file on time, and they don't have an agent. Right, how many real estate agents do we have like that? And they said, well, audit 50. So they did. They went through all the fours, then the threes, then the twos, and they blitzed the city. If you want to keep off IRD radar, play by the rules.
That's
Text.
That's
Sorry?
amazing, Shane. No, that was absolutely wonderful summary, I believe. For a lot of people, especially the ones that are just starting out and don't know all the ins and outs, and also timely reminder for the ones that have been around the block for quite some time of the do's and don'ts. Sorry, carry on.
Tax law is a moving target. As I said before, 6 months and you can be out of date. It can move that quickly. I'll just give an example. When they brought in the non-deductibility of interest, this is what I printed off on the Friday and spent the weekend reading. And that's just on interest non-deductibility. If I can show it on there, it's not showing up on the thing. And we had to come up to speed within 3 days on it. So just because it was done this way 5 years ago, doesn't mean it's going to be done today. All right. Any questions?
Wow. I feel like I've just attended a quick crash course on how to become an accountant, or not to become an accountant and get a proper one myself. That's just absolutely amazing. We had 2 questions coming as you were talking, and I'm just going to scroll back to the beginning and see. So one of the first questions was, what is the finishing of a house? So standalone townhouse, is it considered as a house, even if it's 3 stories?
It is any residential property.
Mm-hmm.
And it is any land that could be used or zoned as residential property. So if you buy land and don't do anything with it, I've got one client who's been waiting 5 years with a property that he purchased. Hasn't done anything for 5 years. He intended to build on it.
Yeah.
Held it for 5 years, and after 5.5 years, he's now moved to Tauranga, and he will probably sell that section and won't be taxed on it.
Okay. So it's the intention as well.
Yeah.
What was the other one?
Hello?
Oh, yes. Cool. I've got a question. Awesome.
Yes.
Oh, yeah. Go, Alina.
Thank you. Awesome presentation. Sorry, you don't see my video for some reason. But I'm here.
I can see you.
You can see me. Awesome. I can see myself. So our question is, we have parents. So it's 2 of us, me and my husband, and 2 of my parents. My parents don't have enough time to be considered for a mortgage, so they have only 10 years to retirement. So we are able to have mortgage for 30 years, but we want our parents to be on a title because we are buying house for them. We are helping them to secure the mortgage. We already have our first home, right? So
okay, because it's not your. Yeah. I'll jump a little bit here, because it's not you actually living in it. So you can have a 50-50 with your parents. Because your parents are living in it, they've considered their home and their half is non-taxable. But your half, if you sell it within 10 years, will be taxable. because you're not actually living in it.
What if we move and live with them because we are trying to buy house for kind of 2 separate living rooms?
If you actually, and the word in the legislation says actually move in as your home, then you're considered the same. Now, I've actually had one case where a couple owned a property in Palmerston. She was living in Wellington because of her job, and she was in Wellington 4 nights a week. The Wellington property was in her name. She actually lived there more than 50% of the time, so it wasn't caught. But her home back in Palmerston, because she was no longer actually living there most of the time, her half was taxable, his half wasn't.
Oh, wow. Okay.
Now, if he also owned the property in Wellington with her and they sold it, she's fine, he'd be taxed on his half.
Yeah.
So in your instance, and quite often, mum and dad will go halves with the kids to buy a property. The kids are fine, but when the kids buy mum and dad out after 5 years, mum and dad will have to pay tax on the increase in value. And it's not the value you put on it, but it's the current market value.
Mm-hmm.
You've got the inverse. You may well move in with your folks, or you might buy a property and go halves with them, and it's their home. If you sell up and they buy you out after 5 years, you're paying tax.
Why do
But because your name's on the title.
Why do we need to sell it to them? Why do we need to kind of change for some reason? Okay.
For whatever reason, if you decide to go back to where you were born, for whatever reason, and your sister comes over instead, and she buys you out, you will pay tax.
Thank you. How do we put them on title? If we already been to 2 banks, banks don't allow because they don't have serviceability of the mortgage.
Well, they don't. What about you?
We have. So we can buy house as investment or as kind of second home for ourselves, but we can't put parents on a mortgage, on the same mortgage.
Then you need to talk to a good mortgage broker.
Simonisa.
Thank you. Thanks, Shane, for throwing me there. No, I believe that also the problem for a lot of clients in this situation, Shane, is where they're confused. Do they need to pay taxes while parents live in it? Like if, for instance, these clients don't live in that house, but the parents do, do they have to file any returns?
Yes, for 50%.
Well, natural love and affection, they can live in the house with no rent. But if you want to claim all the expenses, market rate expenses like rates, insurance, interest, they have to pay a market rent. So if the market rent is $500 a week, for instance, and they're paying $300, you have to pay tax on the $500, even though you're only getting $300 because of natural love and affection. They're associated to you. So if you want to claim 100% of the expenses, you've got to show 100% market rent.
That's no point.
But if they don't want to claim any expenses and there is no income, there is no tax to pay, right?
Yeah, and there are some grey areas in there where IRD can say they should be. So they should be paying a market rent and you should be claiming the expenses and they can come back and assess you. So it depends on the circumstances involved. From an income tax, from a rent minus expenses perspective, it's a little grey. From brightline test, if it's your name on the property, it's going to be brightline because it's not actually your home.
Yeah, but we are not going to sell. And if they will be paying our mortgage, they can't really pay our mortgage, right? If house should be on all names. Yeah.
I
Yes.
think, Alina, you should get in touch with Shane and have
There
a
could be tax involved.
consultation with Shane direct.
Yeah. With details. Agree.
Mhm. That would be great.
Agree. Thank you.
Perfect. But thank you for sticking around for the last hour and a half.
Of course. Thank you so much.
Cool. Do we have any other questions from the audience here? It's just in the matter of time. I understand poor Shane dragged you along here for quite some time. Anyone else has questions? Just trying to read through, Shane, a couple of the ones that we had in a thing. Looks like you pretty much answered throughout the whole presentation there. There are some few tricky questions that I've received into the direct mail. I would suggest, guys, just get in touch with Shane. As you can see, he's awesome. He can explain things really well. And I almost feel like I need a mini version of Shane in my pocket. So for any tricky situations that I come across myself through my personal experiences or through my clients' experiences, I feel like we just need Shane to just come out of a pocket and answer this question. Thank you so much. And if you do have any other suggestions for any topics in the future that we can cover, please come back and let me know. Shane, any parting words before we wrap it up?
It is complex, but you follow the rules and it can be easily put in place.
Fantastic. I like the follow the rules.
That's the long and short of it.
Yeah, I'm follow the rules kind of girl. And I like when I meet another person that knows how to follow the rules. We're on YouTube. We're not going to say anything else. So well done, everyone. Thank you so much. Have a wonderful night. Shane, thank you once again. Remember, this was a part of, I believe, what did we agree on, Shane? Are we doing a 3-part course, or this is a second?
Yeah, we've got a couple. We've got several more to go if you guys still want to go.
Wonderful. And I believe we've done it for the 3rd Monday of each month.
Yep.
So the next one is on the 21st of August, everyone. All right, 21st of August, mark your diaries, 8 o'clock at night, Monday night. Tell your friends, come along, and we'll put it up on Eventbrite as well. Thank you, everyone. Have a wonderful